The U.S. debt has become a major problem affecting the country today. The fact that the nation's debt has dramatically grown over the past few decades and is currently over $31 trillion is not a secret. Although this figure appears unpleasant, we should still understand its meaning and why it matters. What is the exact state of the U.S. debt today? Where did it come from? What are the financial prospects? Well, to be completely informed and make the best decisions possible, we'll address these questions and more in this video. Before we begin, make sure you like this video and hit the subscribe icon. Let's go! The debt ceiling for the U.S. federal government, which is now set at $31.46 trillion, has been reached. Treasury Secretary Janet Yellen has been taking unusual steps, like moving money around or pausing investments, to prevent a full government shutdown. However, these precautions are only expected to be in place until somewhere between July and September. The U.S. government may default on its debt if a resolution is not reached by then, which might negatively affect the economy. Despite these dire circumstances, the current problem is more political than fiscal. The debt ceiling can be raised at any time, even though it now restricts the Treasury capacity to borrow. In reality, since 1960, Congress has increased the debt ceiling 1.2 times in an average year. Republicans' demand for spending cuts from the president before approving an extension is the only explanation for why it hasn't been raised yet this year. Therefore, political disagreements still have the potential to lead to a default, but there is a chance that this urgent issue will be resolved quickly. However, this raises a more important question. Will the government's ongoing need to raise the debt ceiling be a real issue in the future? Deficit spending by the government has been used to pay for anything from infrastructure improvements to national defense and healthcare. They frequently spend more than the federal government collects, therefore, they must borrow money to make up the difference. As a result, the country's debt load keeps increasing. This trend's chart is highly worrying. Anyone can see what it means without being an economist. Some people have even asserted that the U.S. is headed for a debt crisis due to its extravagant spending. While it's important to minimize the risks involved, it's equally critical to acknowledge the complexity of the situation and why, despite having a massive debt, the U.S. is still a long way from experiencing a debt crisis similar to that of Greece or Sri Lanka. So let's dive into why U.S. debt should be taken seriously and why the crisis isn't necessarily likely to happen soon. Even if we ignore the debt cap, it is hardly surprising that governments spend a lot of money. They have a variety of high-cost responsibilities as the largest organization operating inside a nation's boundaries, including paying their staff, supporting military activities, implementing social programs, and developing infrastructures. Taxes are primarily used to pay for these expenses, with individual income tax being the main source of income. The government must take out loans to make up the gap when it spends more than it takes in a given year. This is done in the U.S. by selling or issuing treasury bonds to both domestic and international institutions and individual investors. Therefore, the answer to the issue of who the U.S. owes this money to is virtually everyone, with the majority of it owed to the American citizens and roughly a quarter to foreign holders. Since 2001, the average annual inflation-adjusted rate of growth of the U.S. government debt has been 5.7%. As a result, the federal debt balance has kept increasing, requiring frequent increases in the government's debt ceiling. The debt-to-GDP ratio is a more accurate indicator of a country's debt burden, even though the overall debt isn't always a good gauge of a nation's solvency. The U.S. debt-to-GDP ratio has reached 124, its highest level since the end of World War II. This is an alarming figure because it is similar to the debt levels that Greece and Sri Lanka had prior to their financial crisis. However, the U.S. possesses several advantages when it comes to managing its debt. 1. The U.S. economy differs greatly from the countries like Greece and Sri Lanka because it is the largest in the world and has a great range of industries and depends less on imports of vital goods like food and energy. Since the U.S. has typically seen lower inflation than countries with comparable levels of debt, Congress has had greater leeway when it comes to borrowing. The U.S. dollar's widespread use around the world has also contributed to keeping inflation below double digits. 3. The cost of debt for the U.S. government has significantly decreased as a result of historically low interest rates. Low interest rates have helped the US government even though it has an unbelievable amount of debt, since maintaining it costs less now than it did in the past. The US government can still borrow money at low interest rates, even though the Federal Reserve has increased its own federal funds rate by 4.5 percentage points. However, while borrowing could be helpful in some circumstances, it is important to recognize that this cannot be sustained in the long run, and if we want to become more financially responsible, we must take steps to reduce the national debt. Despite the growing national debt, the yield on the 10-year US Treasury note, which serves as an investor's risk-free rate of return, has stayed low. This implies that there is still a high level of investor interest in buying US government bonds, demonstrating that the market has faith in the US capacity to pay back its debts. To continue luring cash from investors, the US may need to provide higher interest rates, which may burden the government's finances and result in a debt cycle if not properly handled. This implies that there is still a high level of investor interest in buying US government bonds, demonstrating that the market has faith in the US's capacity to pay its debts. To continue luring cash from investors, the US may need to provide higher interest rates, which may burden the government's finances and result in a debt cycle if not properly handled. If not carried out carefully, austerity measures meant to reduce the national debt may potentially have detrimental effects on the economy, as was the case in Greece. Also, the US faces big uncertainty due to the economy's current situation and different dangers, like future economic shocks. Even while there is a chance of a recession, it is dangerous for investors to speculate on the long-term course of the world's largest economy. Instead of speculating, the government should use the chance offered by the COVID-19 related reductions in spending to manage the debt balance in a deliberate and strategic manner. It's important to consider the underlying reason and potential effects of the US national debt as it keeps increasing. Even while the US now has a good debt and currency situation, financing the growing debt may become increasingly expensive, leading to greater taxes, less national savings, and a weaker currency. Making wise decisions that promote a vibrant economy requires a thorough understanding of the national debt and its effects. Keeping the current debt situation in mind may help create a responsible budget and make wise spending choices, which are crucial for the economy to succeed. And that's it for today, guys. If you enjoyed this video, make sure you subscribe to our channel and give this video a like. Thanks for watching. See you in the next video.